the 23rd. We're deep into the sort of new year, I suppose, with some rhythms starting to find their place. It is the sort of morning after the night before vis-a-vis Davos. It seems like the whole narrative of the world changed last week. The princes and kings of corporate universe and a few politicians reconvened the narrative on us. All is well and all will be beautiful. Checks are in the mail. Omar Najia, Global Head of Derivatives at BB Energy. Good morning. We see Brent and both Brent and WTI starting this week above $80 a barrel. Brent 87.56 and WTI 81.62 in early trade in Asia. What's your take this Monday morning? Is the market moving in the direction you're expecting?
We have absolutely no idea what this market is doing, whether it wants to go up, whether it wants to go down. So that's the first point. The second point is that everybody is talking about, China's coming back and all this kind of stuff. So on the back of that only, I think basically that markets now are, across the board are complacent. Equities complacent because, peak interest rates, peak inflation, it's already all behind us. The Davos stuff, everything is good and don't worry, and here we go. And, we have new greatness ahead and don't worry so much about, the BRICS and all the challenges. And the same with the China situation. It's going to save us all. So just on the back of that, I'd be kind of weary. But in terms of something to bet money on, if this market is going to go higher or lower, I wouldn't. I'm not doing very much at all. But if you put a gun to my head, I would say lower and substantially so.
The Vanda Nahari, founder and CEO of Vanda Insights, sitting a little closer than the rest of us to all things Asia and China. Is the reopening, should we be as optimistic, the global markets, Davos, betting the house, that China is going to save the world this year?
I'm not so sure, Sean. I think to some extent I agree with what Omar has said. In terms of oil bulls seem to have drunk from the same punch bowl of optimism that was going around at Davos, as you just highlighted. Are they only paying attention to the good news? I suspect they were. So, okay, let's count. Yes, a few things have gone right, China, and especially if we compare with the really dark period, shall we say, of last autumn, right? October was when the IMF last came out with its outlook, and now it is saying that it is expecting to upgrade it. So, compared with that, Europe escaped the worst energy crisis, okay? China is reopening and inflation is starting to come down. What I'm concerned about is that we may be ignoring the market, or the bulls may be ignoring that there's a feedback loop in here. Because if China is reopening, and as we've seen, crude has climbed 12% from the trough of the first week of 2023, then what does that do to inflation? Because we are cheering that inflation is coming down, and then, and that crude and oil and a bunch of other commodities start going up. And this may only be the beginning, right? We are only seeing the market responding to the prospect of how Chinese economy and demand might look like when it actually starts buying, left, right, and center. What will prices do? And then what does that do to inflation? And then what does that do to the Fed pivot that the market is so has convinced itself is going to happen? So, I think we are ignoring the feedback loop. I don't completely buy into the argument that Chinese reopening will de-bottleneck the supply chains. Okay, to some extent it would, but would that completely offset the increase in Chinese appetite for commodities and the resultant rise in prices? So, I see it not a continuous upward spiral in prices from here. I would bet on a sort of an up-down oscillation, because I think it's far from, we're far from that point where we can say, okay, it's all systems go.
Well, Bill Spindle, you're set up nicely there because the two international analysts, Omar Najee, trader, and Vandana Hari, seem to be clueless as to where we're going at the moment. So Bill, former international affairs fellow in India, Council on Foreign Relations, sitting in the citadel that is New York City, where the center of the universe, really, Bill. Is there any wiser, more clarity the closer you are to Wall Street?
I suppose the single word answer to that is no. I'm not sure I've got any greater insight into it, but I think, they're both right in the sense that, in the short term, it's kind of so far so good in the US with the Fed. In China, coming out of COVID, it seems inevitable that things will, the economy is going to pick up some. But yeah, you looked a little further down the road and you wonder, once China comes out of COVID a bit, they've got some deeper economic adjustments that are going to have to be made over the longer term. And that's a real big question mark as you look further out. And then again, in the US, what happens if this sort of downdrift in inflation just kind of levels off at a fairly high, kind of unacceptably high rate, and the Fed has to sort of change expectations around that. That's really the game that's going to happen going forward, and it's still pretty unclear where the longer term picture is.
Omar, do you see in the structural end of the market, from the point of view of price signals breaking through price levels? I think you said last week that if WTI got above 81.50 or something like that, I can't remember the exact number, but are we seeing any structural changes to resistance, upward or downward?
No, I mean, this is what's confusing about the market, right? So if markets are weak, anticipating a recession, the dollar index should be going up because people look for safe havens. It's actually going down. In a risk-averse market, something like Bitcoin shouldn't be bid. It should be offered. But that's not what's happening. Bitcoin is bid, and strongly so. If you look at copper basically, I mean, I saw that you had this thing, it's going down, blah, blah, but copper, I think, is in a trajectory that's going to push it higher. Usually when you have demand, when you have expansion in the economy, copper goes up. So there are a lot of signals that are pointing towards markets again with WTI. I think in the short term, a close above 81.50 could push us up to as high as $100, but I think further forwards prices come off. So the short term is a bit unclear. But what I'm saying is a lot of these markets are indicating that the market wants to go up. And if you look at the US equity market, this kind of idea that we had, before, in 2022, that, everything will go up and everything goes up forever. And it really doesn't matter how much money you print, because at the end, it'll be like, magic, and you'll see flying unicorns, and don't worry about it so much and forget about debt and all this kind of stuff. I think, at some point, something is going to have to give. Now, if you look at the market, the market is pricing inflation down to about 2.5% towards the back end of this year. And they're pricing, like 2% or something for the next decade. So everybody's expecting everything to be back to normal, and I really worry. And you ask people, what's happening with the war in Ukraine, and everybody's like, yeah, Ukraine's winning and all this kind of stuff. So it just seems to me that the narrative in newspapers, the stuff is all like, and Davos is all like, it's perfect, everything's good. So for me,
I suppose if you're sipping champagne on the Alps, that's the definition of everything's pretty good.
But hold on. Just the point.
Yeah.
The point is, if I'm sitting here and you're going to tell me that somebody's going to come and punch me, I'll be like this. I'll be ready to take the punch, right? And I think the market now is kind of, not ready. The market's like, yeah, everything is fine. So if the punch does come, it's going to have a massive impact. So what I'm looking at generally is I'm saying the risk is that this market does this. I'm not worried about the market, doing this or whatever it is. I'm worried about the market literally going like this. That's where I think the risk is.
Vandana, there does seem to be a gap emerging between the central bank policy outlook, i.e., getting to a plateau and holding for a long time, versus the market view is get to the plateau and correct quite quickly downward in the fourth quarter of this year. That gap from the market's perception and consequently the reaction to risk on versus the central bankers, which are gliding higher. What are your thoughts on that?
Yeah, Sean, it's both amusing and confusing for me. And that's been the case since, and we've talked about this on your show as well, since pretty much the last quarter of last year. And I do notice that especially some Western business media, which shall remain unnamed, seems to be driving this agenda. And, they have a headline today as well, which is quite declarative, that this is what the Fed is going to discuss at its upcoming meeting. So, and when you read through the report, you find that, there's nothing really in the report for them to conclude what they've concluded. So it's like a combination of news reporting and opinion. The headline is an opinion. But what explains this? I really don't know. What explains this very stubborn market optimism that the Fed will pivot? And exactly as you say, spectacular pivot, right? The Fed is saying, and we've had a bunch of officials say from the start of this year as well, repeat that they see terminal rates above 5% through the end of this year. I don't think there's any confusion. I don't know, the market may sometimes be kind of just hanging on to some stray comments here and there, which may suggest. But as of now, the consensus view in the market, which drives the risk on trade or every time, and is definitely wing beneath crude's wings, is that the Fed will maybe do a couple of hikes more, maybe 25 basis points, be done by spring. Hold it there in Q3 and Q4. It's time to start cutting.
Well, if you speak to Vanda, because one of the sort of black swan, this is a black swan event, in my opinion, the speed and the rapid and the comprehensive nature in which China abandoned the COVID zero policy. Everybody was expecting that 23 would deliver a gradual change of policy in China, but we've had this sort of rapid change, out of character change. When you take that point, the sort of out of character nature of this sudden shift, do you take anything from that? Do you read anything new in the crystal ball of that? Does China have the ability to change that quickly once a policy is announced?
So if you paid attention to the comments by Liu He, who was China's top delegate at Davos, he's the vice premier and the economic czar of the country as well. He spoke a very bullish story, and he said that it's normalizing. Well, it's past its peak. It's normalizing faster than we expected. And to some extent, the about turn, the abruptness of it that you're referring to is actually helps underpin comments like that, and helps at least the optimists in the market take it for granted that yes, from here on, it's like, I said all systems go before, but that's what it's going to be for China. I would be very, very cautious, Sean. So is it reopening? Are people starting to travel again? And I certainly see it in this part of the world. I can feel when I step out, the number of Chinese tourists that you're starting to see again here in Singapore, and Southeast Asian nations are celebrating as well. The Chinese tourism dollar is back in the economy. So yes, I think definitely we're going to see a spurt in the next few weeks and months, which is, I've said this before, I think is going to be entirely driven by pent-up travel demand. So you will see jet fuel demand going up. But really, the real test is going to be how and when is the Chinese government actually able to inject momentum, real momentum into its economy. And, Liu have sounded very, very confident that this year, in 2023, they'll return to normal rates, which is like, I suppose, 5% and above GDP rates. But I would take that with a pinch of salt. I think it's going to be an uphill battle for the country. It will get there. Will it get there in even the second half of 2023? I'm not so sure.
Bill, I think America is kind of exhibit A for COVID revenge spending, isn't it? I mean, the scale in which we saw the savings over COVID apparently calculated somewhere in the region of $3 trillion that was not spent on going to Supermax or going to the movies or going to whatever you would have normally done. On top of that, you had the stimulus packages of $1 trillion plus here and $1 trillion plus there. There's just so much money in the system that is defying the projections of recession and everything else. Your thoughts?
Yeah, I think that's true. You've seen a big surge back, and I think that's going to taper off. But what's still interesting is that this soft landing scenario remains alive. It is really difficult to land this into a soft landing. And, what's holding things upright, holding things kind of optimistically now is that it still remains a possibility. It's hard to rule it out, though it still is really a big challenge. You've got, Microsoft and Google with substantial layoffs in the headlines. And yet, if you look at the overall aggregate jobs numbers, they're really not showing that much erosion. And at the same time, inflation is tailing off. But as Vendra points out, that doesn't mean that it's going to go right back down to 2% and all will be well again. It's going to taper down, and then we'll see where it levels off. And if that's a level at which the Fed can kind of hold rates steady or maybe even begin dropping them, well, that's wonderful. But that is still a remarkable achievement if they pull that off by the end of the year.
Omar, you've always said that the Fed would blink on this one, given the scale of debt. I think maybe that's what we're seeing before our eyes, that the punch bowl isn't being taken away and the Fed are going to pull back here, given the scale of debt. Your thought on that narrative as the outlook for the year ahead?
So the deepest markets are the currency markets, right? And you've seen the dollar start to dive against, 12 years of going up. And now the dollar's falling against the euro, against the GBP, against the yen, right? So those have been falling. The yen, the euro, the GBP have been falling for 12 years. So you've seen basically an abrupt change of trend now. So the correction from what the equity market is suggesting, that correction is going to last for a long time. You're looking at least 5-6 years, right? That's one. And then basically equity markets don't seem to want to fall. Yeah, that's two. Bitcoin's going up, as are precious metals, copper, blah, blah, blah. So what scenario do you have that would cause the US stock market, let's say, to go from 4,000 to 7,000? What scenario would you have for oil to go from $80 to $150? And what scenario would you have for the dollar index to go from 101, something like that, down to 80 over time? GBP to rally back up from 120 where it is now up to 145, 150. Euro to do the same thing and rally from 123 to 145, wherever. So what scenario would that be? There's only one that I can think of, which is called hyperinflation, right? That's the only scenario that I can think of, because it's not going to be, the US economy is doing so well, debt is massive, all this kind of stuff. And if you have hyperinflation, you kind of solve a very big debt problem, which is basically the biggest problem facing the West, right? So that's what I kind of, to be honest with you, I don't know. But to me, that is something that would explain all the stuff we're seeing. If we have massive inflation, I'm not talking about 10% and 2%. If we have like 20% inflation, and you don't know what to do with your money because it's not doing very much, you just buy anything. Anything at all. So I don't know. Honestly, I don't know, but I can. There's a lot of stuff that you can say, but directionally, right now, I'm I'm confused. I
Well,
really am.
let's go to the survey question and see if the collective herd could give us some view, because the IMF is meant to know about these things. And only as recently as 3 weeks ago, they told us that 1/3 of the world economy would go into recession this year, including the US and Europe. In the interim few weeks, it would appear the greater minds at play say, no, hold on there, not so fast. Europe won't go into recession as the headline over the weekend. Your views on whether the IMF got it wrong with their call on January 1st. You agree that they got it wrong, or you disagree that they did indeed get it right? Your thoughts. IMF was wrong. Agree or disagree? Looking at that, Vandenet, from the point of view of all things oil, supply, demand, balance, having said everything we've said for the last 20 minutes, the oil markets are relatively unexcited. I mean, yes, they've crept up a few dollars, but if indeed the oil markets thought that China was back in that sense of exclamation point, you would think would be banging on 100 and not creeping slowly up through the 80s.
Yeah, I guess you could argue. I mean, I think it was quite a spectacular jump, because we started the year in a rather bleak mood, and we had, oil under considerable pressure in the first week. We've gone for Brent from $77 to $87. So I think it is still premature. But if you think that that's still not, crude doing too much, I guess we just have to agree to disagree. Where does it go from here? So as I said, I think there's going to be this feedback loop. At what point it really starts hitting the market, that it's not just everything looking rosy from here onwards. I really don't know. I think we have a couple of important events, of course, coming up. So we have the IMF's World Economic Outlook, on the 31st of Jan. Around the same time, we have the Fed meeting. And then we have, of course, the OPEC plus JMMC meetings as well. So I think there's going to be a few events coming up that may end up sending a lot and confusing signals to the oil market.
Bill, you are a close watcher of India. You spent many, many months there last year. India, regardless of the IMF's outlook and some of these contradicting sort of crystal ball reading, India, it's pretty clear. It's had a great last fiscal year, 8% growth. It's on target for 6 to 7% growth. It's enjoying a lot of discounted Russian oil. What's your outlook for India?
Yeah, I think they've had their big comeback from COVID, and that's been a big boost. I think they're now going to taper a bit from that. There's still a lot of structural work to do in India, economic wise. So I think they'll continue to do pretty well if all things being relatively the same in the global economy, but it'll probably taper off a bit. The other thing I would throw out with Omar mentioned it briefly, but the war in Ukraine that is a raging war right there in Europe, and it would hardly be a black swan.
And the big debate over the weekend was whether to send them tanks or not. And it seemed the last headline I saw on that, the Germans are still holding off, but seem to be giving a green signal for others who have the German Leopard tanks. Yes, you can send them.
Yeah, and also I think the price cap was introduced pretty smoothly. It doesn't seem like it's having much of a big effect, but none of this is a stable situation. This is a war. It would not be surprising if it takes a sharp turn one direction or another, and really becomes suddenly right there at the center of the news, because it is just not a stable situation.
Well, it is a conflict that is stuck in a winter freeze, if you like, literally, and all expectation is that will become quite hot again into the spring, and hence all of this discussion around heavier weapons being sent into Ukraine. In terms of U.S. politics, Bill, just to get your views on that, from where that's starting out the year, we're kind of back in Washington. The Congress has gone, or the House has gone to the Republicans, although barely. Is there any drama or direction to come from US politics at the moment?
Well, the debt ceiling is the big debate now, the big headlines. I think that too is a little situation that's a little bit hard to predict. The normal pattern is lots of headlines, lots of hysteria, lots of pulling of hair, and then finally a deal that seems like it would logically happen, especially since you don't need very many sort of sane Republicans to come around and push a deal across the. But at the same time, for the first time, you've really got a small but very determined group in the Republican Party that is probably willing to, as I heard someone describe it yesterday, shoot the hostage at the end of the day, which is pretty, it's a pretty volatile element as well.
Yeah, I think there's the shoot the hostage. Yeah, the hostage being the US dollar there, perhaps. Omar, looking at where the sort of direction of travel goes from the context of liquidity and volatility, we saw a lot of actors stay away from the markets, the oil markets, in the second half of last year, mainly due to volatility, as well as the uncertainty. There's a lot of money was made in the first half of the year, but where is volatility now going vis-a-vis attracting a lot of that sort of mutual fund money into oil and commodities?
So oil is not really, I mean, it's a commodity, all that kind of stuff, but really it's financialized so much. It's a, financial instruments, financial market. And basically, money flow is much more important than, fundamentals and counting cargoes all the time. Anyway, so the bottom line is that every fund that I know of is long, and not just long, but super long. And they're buying, and they've driven this market higher, and they don't just buy crude and stuff like that. They're buying cracks, so they're buying the product against the crude. They're buying lots of distillate cracks. They're buying gasoline cracks. They're buying jet fuel, like Vandana was saying. So they are long, and a lot of the brokers that I speak to, oh, I just had my fund guy buy I don't know how many a month. I just had another fund buy, this many a month, et cetera, et cetera, et cetera. So I definitely think that this is the financial flows into oil are quite large. The one thing that I would say is when you see, this substantial money from, hedge funds, whatever you want to call them, come into the oil market, they usually indicate when markets, they buy when markets are toppy, and they sell when markets are bottoming. So it's an interesting signal. So again, there's not much that you can say, but I mean, think of it like this: if they decide to get out, it's going to be a very crowded, very, very crowded trade. So just to put it into perspective, 2023. Cracks on gas oil were down to about 24, 23, something like that, and they shot up to, I don't know where they are now, maybe like 29, something like that. That's massive. I mean, that's ginormously. That's like, that's strong. The front got bid up to like $40, and that's massive. I mean, the strongest it was. Back in, I don't know, September or something like that, was about 50. So we're not far off those kind of nutty periods. And all on the back of, China is going to come back, I think. So, we haven't done anything, so for what it's worth.
China is going to come back. There it is. That's January 2023. China is back, or China is going to, is ultimately where you place your bets on the table. An interesting headline just to close out with on that, which I think makes China is back, or China is coming back. And there's our survey result, still in our room. People disagree that the IMF got it wrong, and indeed they were right when they called recession as being a big factor this year. But the interesting headline just out of India this morning is that Apple is targeting to raise its production of iPhones to 25% of its global production into India, to move it from China to India. It's now at 5 to 7% in India, having started at 0 not long ago, and now up to 25%. And if you take that Apple move as a reflection of the shift in global supply chain away from manufacturing in China and moving it to other places, may indicate where does the China's back narrative go over the medium term, if indeed the big supply chain shift is a very, very real factor in China's economy going forward. Anyway, we'll have to wrap it up there. Thank you so much, Omar Najia, Global Head Derivatives of BB Energy, Vanda Nahari, Founder and CEO of Vanda Insights, and of course, Bill Spindle in New York, former International Affairs Fellow in India, the Council of Foreign Relations. Thank you all very much. We'll be here every morning, 10:30 UAE time. Oil trading a little bit unchanged, but Brent well above $86 a barrel. All the best.
Thank you.
Thanks.